Think your startup is ready for venture capital? Not so fast. Venture capital investors, or VC investors, don't just throw money at great ideas. They meticulously analyze your business model, financials, and scalability before writing a check. What exactly are they looking for? What will make them say yes to funding your startup? Today we're breaking down the VC or venture capital checklist so that you can prepare, avoid common pitfalls, and position your company for success. Hey everyone, I'm Corey, a startup lawyer helping entrepreneurs decode law, technology, and innovation. Today we're diving into what VCs or venture capitalists look for before investing, the biggest mistakes founders make, and how to prepare for due diligence. If you're a startup founder seeking funding, this is a must-watch, so let's get straight into it. Here's what we'll cover in this video. Is your startup VC fundable? Key financial metrics investors analyze, why a clean cap table is critical, how venture capitalists conduct due diligence, how to avoid deal breakers before pitching. Now let's break it all down. So first, is your startup venture capital fundable? Not every startup is a good fit for venture capital. VCs, or venture capitalists for short, look for companies with high growth potential, scalable business models, and a path to significant revenue in 5 to 7 years. So what do VCs want? They want large, addressable markets, usually billions of dollars in potential revenue, a scalable business model that can grow fast with funding. They want a strong competitive advantage, for example, proprietary technology, network effects, etc., and experienced, coachable founding team that can execute. Now, everyone doesn't have experience, but the second part is more important. Coachable founding team that can execute. VCs are not interested in slow growth businesses, startups with limited market potential, founders who are unwilling to give up equity or control, in some mix that varies case by case. If your business doesn't fit these criteria, VC funding may not be the right path for you. Next, let's look at key financial metrics investors care about. While VCs don't expect early stage startups to be profitable, they do expect financial clarity. Here I'll go over a couple of metrics that are key areas venture capitalists will look at depending on where your business is in each stage of growth. And so you'll have to take this with a little bit of grain of salt depending on who you are and what your situation and circumstances are. Let's get into it. Revenue growth rate. Is revenue growing quarter over quarter? Burn rate and runway. Pretty much all venture capitalists are going to look at this, and this is how long until the company runs out of money. Gross margins. Are unit economics scalable for your business? Customer acquisitions costs, or CAC, versus the lifetime value. Is the growth you have or projecting to have sustainable? Churn rate. Are customers sticking around or are they leaving too fast? Pro tip, you should have a well-organized 3 to 5 year financial projection that can clearly explain how VC funding will drive growth. So next, how VCs conduct due diligence. Before offering a term sheet, VCs conduct a deep dive into your business. Here's what they're going to check. They're going to look at your market and business model. Is there real demand and can the business scale? Financials and growth metrics. Are the projections that you're presenting realistic? Your cap table and equity structure. Is ownership in your business structured for long-term growth? Legal and IP protection. Are there any regulatory issues or lawsuits outstanding? Team and execution ability. Can the founders handle scaling challenges? Next, they'll also look at things like sales and traction. Does the startup already have paying customers? Here's another tip. Create a virtual data room, or VDR, with financials, legal documents, and growth plans in a file storage system like Box or Dropbox or SharePoint to speed up the due diligence process and show the VCs that you're professional and have the basics together already. So let's recap. VCs look for high growth startups with scalable business models. Key financial metrics like customer acquisition cost, long-term customer value, and burn rate matter. A clean cap table is critical for securing funding. Investors will conduct deep due diligence before writing a check. And the better prepared you are, the smoother your fundraising process will be. Remember, we'll be covering convertible debt and safe notes in an upcoming video, so stay tuned. Join me on the path to decoding law, technology, and innovation to grow your business. Don't forget to like, share, subscribe, and hit that notification bell. Until next time.